Talking about getting qualified as a self-employed borrower. So you're self-employed or you own your own business and trying to qualify for a mortgage. And anybody that's been through this knows that it can get a little bit dicey, but it doesn't need to. I come at this from a couple different directions. One, I've certainly done a lot of self-employed borrower loans and mortgages, and so I've got a lot of expertise and familiarity there. But I also, as a self-employed owner of a mortgage company, I've actually gotten my own mortgages, not only purchases but also refinanced as a self-employed borrower. So I have some personal experience kind of from the borrower side. And so that's what I want to share with you today. Again, at the beginning, before I go over anything, the most important things to keep in mind is one, it doesn't have to be scary. And two, the only thing that you really need to focus on is good preparation and good documentation and really being forthcoming and work with your lender or your underwriter to make sure they fully understand your complete sort of qualification. So the areas that most borrowers and lenders, quite honestly, that aren't familiar with approving or qualifying self-employed borrowers, they get tripped up in the income part of the equation. And so unlike being an employee, a self-employed borrower really has two parts of the equation that the lender needs to be concerned with. One is just the income they get from their business, but also the stability of that business that they own that's providing the ongoing income that they'll obviously pay or repay the mortgage loan with. So as a result of that, the documentation that you're going to need to provide reflect both parts of that equation. And so those documents specifically are the last 2 years of your personal income tax returns, as well as the last 2 years of your business income tax returns, and then your financials from the business. Generally, this is your profit and loss statement and balance sheet from your business. And really, the underwriter is just going to look and see, one, do you have enough income to repay the mortgage? And then two, the actual entity that's providing that, the business that you own, has that been stable and consistent in providing that level of income? And then that's what they use to determine. So there's a couple places that usually become problematic when they do that evaluation. The first one is there's always this inherent conflict or competition between taxes and lending. So a lot of times your accountant or your tax preparer will try to save you the maximum amount of taxes, and as a result they write down a lot of the revenue or income that's coming out of the business, and that can become problematic because then when you look at your taxes, it doesn't look like you have enough income to afford the mortgage, and it's just because you've kind of taken all those write-offs. And so you need to make sure that when you're going into your sort of tax equation and you're working with your accountant, you're making sure that you're able to show sufficient income to pay for a mortgage. So that's one area. The other area is in large deposits. So a lot of times a business owner will sort of, especially for sole proprietorships, some of those funds get a little messy and commingled. Or even if you're not a sole proprietorship, you may take distributions in large lump sums. And so what an actual lender wants to see is consistent month-over-month payments, and hopefully those payments maybe are going up over time, or distributions, not payments, but distributions or income over time. Sometimes, and again, this just becomes an education and documentation issue to the underwriters, is if you have little intermittent large deposits, sometimes those can be problematic and they don't really look like good consistent income. So large deposits and that conflict between your tax optimization versus your income optimization, which is what you need for a lender, can be the two areas where you can get into a little bit of trouble as you're trying to get qualified as a self-employed borrower. So bottom line is good documentation, good preparation, and make sure that you can really explain that income part of the equation. And then of course, good credit scores help. Lots of assets or reserves. If you've got 401ks and you've got savings and all that stuff in your personal accounts, that can all help as well. So if you need any help, you can visit us at velocitylending.com. One of our licensed loan officers would love to walk through that. We have tons of experience. And like I said, I've personally been through it, so I empathize with you as a borrower on trying to get qualified as a self-employed borrower.